About the origination,
Yeah.
what's the importance of that to a passive investor?
In terms of the loan,
Yeah, absolutely.
yeah. I mean, you have to look at it the way I started looking at investing. Most of the deals that I did at the beginning, I was trying to replace my income with cash flow. And so most of those deals were stabilized deals. They qualified for Fannie Mae, Freddie Mac, so 90% occupied for the last 90 days. It didn't have a huge value add lift, not a ton of capex. We weren't, cleaning out the whole tenant. We were just doing a basic, 3 to 5 thousand a door rehab. So that qualifies for Fannie and Freddie, right? And so when I'm as a passive looking at a deal, that to me is a pretty safe deal, right? You're going to probably get, 10 to 15% IRR. You're going to get 6 to 10% cash on cash in that range, depending on what year we are. In 2015, it was 8 to 10% cash on cash. And then the last couple of years, it's been 6 to 8%, I would say. And that what I was just sort of call like a straight sort of yield deal. And so my first, I would say 15 to 20 deals were exactly that. They were just, easier deals, not a huge value add lift, but they were safe. And then, so from the loan side, if a deal qualifies for Fannie or Freddie, I feel pretty comfortable. There's usually, most people are getting 7, 10, 12 years on their loan term. So if a downturn does come in, it's not the end of the world, right? Like I don't have a maturity right now this year. Um, Whereas if you get into more aggressive deals, they're usually going to require a bridge loan, right? So you might be 75 to 80% loan to cost. It might be a 3-year term. And that to me, as a limited partner, I'm taking more risk, right? Because if that bridge loan has maturity, in the next 6 months, then you're in trouble, right? Because you're going to have to either refi or sell that deal in the next 6 months, and you might hit a downturn like we just hit. And so that's why I think for bridge loans, you have to get a higher return on that money. And I just finished reading one of Howard Marks' books, and he runs Oak Street Capital. And the way he describes it is there is a lot of times when we look at returns, you only see best case scenario. But the way he looks at it is the further you go out on the risk curve, then the wider range of returns that you could get, right? So on a Fannie deal, right down the fairway, 90% occupied already, limited rehab, that deal might be anywhere from 10 to 15% IRR. But then if you go and do a bridge loan and it's a heavy rehab, they're showing you 20% IRR on the sheet. But then it also could be a 0% IRR, right? So as a passive investor, you have to be aware of that volatility of risk. And I think once I got comfortable with my income sort of being set with enough passive deals that were just, down the middle, then that's when I sort of went further out in the risk curve to try to get higher returns. But if deals start going bad, then those could come back as zero, right? So that's the risk that you take on those deals, because it could go, you put in 100 and they could give you 200 back, or they could give you zero back. And so that's the risk you have to take. And I went out further once I had sort of that foundation of cash flow though.
Oh, I love that. I love how you figured out your lane and you figured it out quickly. And I want to